this is really our attempt to answer today's urgent question. The question being, if you're lucky enough to have any money, what should you do with it right now? Holly, good afternoon to you.
Hello, thanks for having me.
Oh, it's great. It's great to have you on. Can we just check something really basic? If you have a workplace pension, is that going to be all right?
Well, your pension will be okay. I know the panic of the last couple of weeks was around final salary schemes. There are lifeboats and protections around those. So I think whatever was happening, people's pensions weren't at risk. A problem for newer pensions, defined contribution pensions, is that the stock markets are falling. So that will reduce the value of your retirement savings. That's a concern, particularly for anyone who's nearing retirement, who might not have the time to sit in the market and make that money back up.
Right. So if you're, say, 35, this isn't all that worrying for you because they go up and down, don't they? That's what happens. Markets go all sorts of different ways in any number of different decades.
Yes, and the idea is with a pension, you shouldn't be able to touch that till about 65, maybe older, depending on your age, and you have got time to ride out those markets ups and downs. And most pensions are supposed to de-risk as you approach retirement. That doesn't always happen or doesn't always work, but it should be that more money comes out of equities and the stock market and into cash and government gilts, whatever they're up to today. So there is less volatility as you do near retirement age.
If you're in the position where you put a bit of money away each month into your pension, should you not bother at the moment or just put less in? What would your advice be?
I mean, it's a really difficult one because if you stop pension contributions, that is robbing Peter to pay Paul. On the other hand, if you are really struggling to make ends meet, then absolutely stop pension contributions. I think it shouldn't be your first port of call, especially because for a lot of people, the percentage that's coming out of their workplace pension is really quite small, sort of 3 to 5% of their salary. But people shouldn't put themselves into financial hardship just to keep their pension savings going. We can all afford a short break, I'm sure.
Can we move on to houses? Because obviously mortgages are a very, very trying proposition for an awful lot of people at the moment. If you're thinking of buying a house in the first place, should you just pause that thought?
Oh, it's so difficult, isn't it? I think if you're buying a house, you can't predict house prices. I mean, we know in Britain we have a chronic housing shortage, and that's a major problem. So even if there is a short-term correction in the market, we're not going to see house prices halve overnight. I think more of a concern for people at the moment is mortgages and mortgage repayments and what they can afford. Perhaps what they would have been able to afford 6 months ago is now suddenly out of reach. So that might cause people to reassess their plans and wonder about holding off in case interest rates do start to dip again. I think it's kind of important to say that we're not going to go back to 1% mortgages because we're very unlikely to go back to a 0.1% Bank of England base rate. But this sort of 6-7% that we're seeing at the moment hopefully will be short-term pain, and it should find a sort of medium ground that's a bit more manageable for people.
So would it be unwise to get yourself tied into any type of fixed rate at the moment?
I mean, it really depends on your situation and what kind of certainty you're looking for. What we're seeing actually is those longer term fixes are starting to look like better deals. So 2 and 3 years have gone up massively, are really expensive. Actually, if you're looking at 5, 7 or even 10-year fix, they're still quite reasonable and quite affordable in the grand scheme of things. If you are going to go for a long-term fix like that, you obviously have to really think about your circumstances, if you're going to be staying in that property, or about choosing a mortgage that you can port. So if you do move home, it can move with you and you don't incur a massive early repayment charge for trying to get out of it.
And if you think that you're not going to be able to make your payments on your mortgage, particularly if you're coming off a fixed rate, so possibly your repayments are doubling or trebling, are you likely to be given a period of grace by your bank or building society? Do they have to do that?
they don't have to, but they don't want you to default. I think what's really important to remember if you are going to take a payment holiday, though, is that even if you're not making those monthly repayments, your interest is still accruing. So you still got to pay off. You'll end up actually paying more over the term of your mortgage because that interest is built up for a longer period of time. So if you are going to do one, it really should be a sort of short-term emergency plan while you get yourself back on your feet.
And if you're a renter, Holly, it's likely that your landlord is going to have to put your rent up. Or do you have any rights here? Can you stop them putting it up? Can you refuse to pay the increase?
I don't think you can refuse, but I think, again, it's important to have a really open conversation with your landlord about what you can afford and what is reasonable. Landlords, especially landlords that are doing a sort of all-in price where your bills are included, may be really worried about energy bills as well as rising mortgage rates. But hopefully, for the most part, they are reasonable, and what they want is a tenant in situ.
Yeah.
They don't want to triple their rent and then not be able to fill that property.
But if you
but you do hear.
Sorry to interrupt, but if you are a landlord who could afford not to increase the rent, then at the moment you shouldn't really increase it. And I appreciate not every landlord will be able to keep the rent at the same rate, but if you can possibly do so, you should really, shouldn't you?
I mean, that would be the dream situation, wouldn't it? But I've seen some horror stories. I saw on social media at the weekend, one person saying that their rent was going up from £775 a month to 2,000, which, no matter what's going on in the landlord's finances, there seems quite disproportionate. So I guess there's always going to be heroes and villains in this situation. But I think just having sensible and calm discussions ahead of time and giving yourself plenty of time to look for alternative accommodation if that before your rental period comes to an end, in case you can't afford it, then just give yourself as much room as possible.
And savings, I mean, if you have, very briefly, if you can, premium bonds, are they a safe harbour? I don't know, post office, savings account, what would you recommend?
I mean, premium bonds are super safe, but they're not going to grow your money at the fastest rate. So it depends what you're looking for. It's, with mortgage rates spiking recently, what we've also seen is savings rates spiking. So you can get now a 1-year savings bond paying 4.5 or 4.75%. But if you do want to get a savings account, then you just have to keep your eyes out and move really quickly, because some of these deals are going within hours because demand is so high.